Where are property markets heading in 2022? Now that we've got 2 months of data under our belts, the big picture's becoming clearer. Last year, property values increased almost everywhere around Australia. Now that's very unusual. In fact, around 98% of locations around Australia recorded a price uplift, and most of them had double-digit growth, when many properties, in fact, grew much more than 20%. But as I said, that's not the way property markets normally work, and moving forward, the various property markets around Australia are going to be segmented. Now, of course, that's more normal for our property markets, and that will be related to affordability, and even within the same markets. Clearly, there's not one Melbourne property market, one Sydney property market, and so that means that certain segments will outperform others, again related to the ability to borrow money and pay more. So in 2022, some locations will rise strongly in value, some will increase in value moderately, some locations will languish as affordability becomes an issue, and a few areas are going to still experience falling price values. And that's all, of course, based on local demographics, economics, and supply and demand. We're going to talk about that in today's podcast, which is the audio of one of my weekly Property Insider videos that I do each week with Dr. Andrew Wilson. We're also going to talk about what's now going to happen to interest rates, considering that wages growth really wasn't as strong as some people had expected it to be. Now, if you're a regular listener to this podcast or watch my Property Insider videos with Andrew Wilson, you'll know that we've been suggesting interest rates aren't going to rise for some time. So, as I said, today is the audio of last week's Property Insider video, which you can get at my YouTube channel or go to propertyinsiders.info. But you don't need the video. There's a few charts that would be in the original, but I think we explain it pretty well. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
When is the Reserve Bank going to raise interest rates? And how high are interest rates going to go this cycle? Well, they're the questions commentators have been speculating about in the media for some time now, haven't they? And of course, homeowners and property investors are concerned about this. But in these regular weekly commentaries, Dr. Andrew Wilson and I have been explaining that the circumstances aren't right yet for the Reserve Bank to raise interest rates, despite what the money market thinks and despite what many commentators believe is going to happen. So what does the latest wages data tell us? What does it mean for interest rates? That's one of the questions I want to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. And I'd also like to ask him his take on what's really happening in our property markets now that we've got a couple of months of data under our belt. Hi, Andrew.
Yes, g'day, Michael. It's certainly been an interesting week, hasn't it?
Well, it has. Look, while our economies continue to outperform some expectations, many economists and commentators brought forward their timing of the Reserve Bank cash rates. In fact, some even said it was going to happen as soon as June this year. But recently, the wages data has come in, and that's actually told a very different story, hasn't it? We're not there yet.
Well, it certainly has told a different story from the point of view that for those who've been predicting higher interest rates this year from the Reserve Bank, it was always predicated on an outbreak in wages. We know inflation's been rising. We know why. There are COVID-related factors. The cost of oil and house building costs have skyrocketed due to COVID issues. And we need to have higher inflation working with higher wages to move into that wages prices spiral of the 70s that would activate reserve banks. Now, they're a lot closer to that environment in the US because US wages are responding to higher prices because they have a different labour market. We, of course, have noted that despite lower interest rates and lower unemployment, we haven't seen wages growth over the last decade that we had in previous economic cycles. And that's because wages are quite sticky in Australia as they respond to higher prices. So no surprise, we saw the same result For the December quarter, when the ABS released the data last week, we saw a 0.7% increase over the quarter in wages, which was actually the highest quarterly increase, Michael, that we've had since 2014. But no surprise that we did have a bounce back in the quarterly rate of growth for wages, given that we're still responding to the downturn through COVID, the COVID shutdown. So it's just a rebalancing of wages growth. But even at that 0.7%, the annualised rate of growth for wages was just 2.3%, which takes us back to the pre-COVID subdued wages growth that we've really experienced since the GFC. And given that the Reserve Bank has consistently said that it needs to see wages growth above 3% for a sustained period before it acts on interest rate increases, we are so far behind that now that it's certainly well out of the question for this year, 2022, and still is problematic for 2023. Even if we had 0.7% per quarter for the next year, it still would bring us under that 3% benchmark from the Reserve Bank, Michael. And really, those that are still predicting interest rate increases this year, it's not rocket science. It's just really stated the parameters for rises have been stated by the Reserve Bank, and we are far beneath those parameters. And of course, that's despite the fact that we have the lowest unemployment rate since 2008. So low unemployment rates are not driving higher wages. And if anything, we're going to see upward pressure on our unemployment rate into the future. We will see participation rates are still lower in Victoria and New South Wales as a result of COVID shutdowns. So there will be more workers moving into the workforce, creating competition for jobs. And of course, the really big force for labour supply is migration. And we're clearly going to see the return of mass migration almost immediately. And just to put that in context, Michael, if we look at the past 2 years, the growth in the workforce over COVID has been just 0.8%, which is quite low, particularly when we compare it to the previous 2 years when we had 3.6% increase in the workforce. Now, the difference is around about 400,000 workers. So we've had a shortfall of 400,000 workers, of course, because of the end of migration. And that, of course, has been a significant factor why we've had a shortage of labour and low unemployment rates. But that's about to be reversed. We will have strong competition for available jobs as those migrants re-enter Australia. And that, of course, will put upward pressure on the unemployment rate. And, of course, it'll put downward pressure on wages growth. So, again, this isn't rocket science. It's just the reality of the environment that we're in at the moment. And, of course, over and above all of that, Michael, is unfortunately the European war at the moment, which is certainly going to add a lot of uncertainty to central bank decision-making. That'll mean more of a wait and see the attitude rather than increases in rates, which have been certainly foreshadowed sooner rather than later in the US. So really nothing's changed, Michael. I still think that the outlook, if we could say that, is for the foreseeable future. There is certainly no chance of an increase in interest rates given the data that's coming out. If anything, we're going to see the factors move against a tightening of the labour market and upward growth in wages.
Well, the Reserve Bank wants our economy to keep growing, and it recognises the economy won't be able to sustain its upward trajectory until real wages growth occurs. So even though wages have gone up a bit, most people recognise that it costs them more to live than their wages have gone up. And the Reserve Bank recognises rising interest rates would only dampen the economy. It would stop us spending, consumers and businesses. So as you say, it's too early in the cycle to do that. But let's turn our attention to the property markets. And now we've got 2 months of data under our belt, even though January is always an interesting month. It's a holiday month and the markets are a bit different. But what's your take on what's happening to property now that we're at the end of February?
Well, very interesting month, Michael. Firstly, we've seen across the board rise in listing activity, particularly the auction markets. We've seen record numbers of auctions in just about every capital cities conducted for the month of February. We've also seen record numbers of sales. So even though we're getting significant new listings or auction listings into the market over February, clearance rates have held up, which means actual numbers of sales are near record levels, and in some capital cities clearly at record levels. So record listings, record sales, well above February last year. That really does does reflect that the strong underlying forces remain in our housing market. And in terms of the economy, we're also going to see demand fertilised this year with the return of migration, with open borders, international migration. And so February's been a very positive start to the year, Michael, for the auction market. And we've seen perhaps on the weekend with these very high numbers of listings, some easing in clearance rates, just starting to taper down a little bit. It's the old law of supply and demand, just testing buyer depth. Nonetheless, clearance rates are still high and do reflect what remains a seller's market, even with the Melbourne market, which was just over 70% on the weekend, but again from high listing numbers. So those metrics are still positive in terms of the level of demand and supply in our housing markets. But what's really interesting, Michael, is that we're seeing some differentiation in prices growth. And I think that's the new reality for our housing markets, is that even though we're seeing strong supply and demand outcomes, particularly in Melbourne and Sydney, we're not going to see the same sort of prices growth that we would expect for those near boom time clearance rates. And that's because the strong prices growth last year in Melbourne and Sydney particularly has crashed affordability. And it means that even though you're wanting to buy a house, you can't get the same finance deal because you don't have the income to support it. So that means that we're going to see a flattening of prices growth this year, particularly in Melbourne and Sydney. Now, by contrast, the more affordable markets of Adelaide and Brisbane are continuing to see strong prices growth, and that's because they have a clear affordability advantage over particularly Melbourne and Sydney. So they haven't reached their affordability ceiling yet in those capital cities, whereas Melbourne and Sydney clearly have. So even though they're still engaged in the housing market, they can't continue to bid up prices anywhere near what they did last year because they don't have the capacity to be able to borrow more because of those affordability constraints. Going forward, given flat interest rates and given flat wages growth, it means that as prices growth continues, it will reach an affordability ceiling, which we've seen in Melbourne and Sydney, and which I think we will see in Adelaide and Brisbane this year. But there's certainly some upside to prices growth in those two markets until they reach their affordability ceiling that Melbourne and Sydney have had. And you've got to remember that median house prices in Sydney are double that of Brisbane and well ahead of those in Melbourne. And yet incomes are around about the same. So that's the difference, is that there's more capacity for buyers in Brisbane and Adelaide to push up prices, and that capacity is severely restrained now in Melbourne and Sydney because of the extraordinary prices growth of last year.
Now, I know you track asking prices as opposed to sale prices, because while they correlate very closely, asking prices seem to change a bit sooner than the reported sale prices. And February was a pretty flat month for our two big property markets, Andrew.
Yeah, and I think that's just validating what I've said, Michael, is that the capacity to push up prices, and of course that's then reflected by sellers pitching their particular properties, is being constrained. So we've seen flat asking price growth in both Sydney and Melbourne. But by contrast, Adelaide and Brisbane have seen asking prices continuing to rise quite strongly, particularly the Brisbane market, where asking prices are higher. But also it's interesting to see the number of properties listed for sale in total, Michael. And when we look back the change over the past year, we actually see that there's an increase in properties listed for sale in Sydney. Melbourne is reasonably flat, but there's been a significant decline in the number of properties listed for sale in both Adelaide and Brisbane over the past year. And I think that does reflect the differentials in the markets, not just that there's less competition for property, but it means that properties are selling quickly in Adelaide and Brisbane and going off the market. So compared to a year ago, of course, there's a significant decline in listings in properties on the market in Brisbane and Adelaide. And again, that reinforces what we've just said about that, I guess, two-speed property market that we have. Two-speed in terms of price outcomes, Michael.
Well, last year was an abnormal year. It was really unusual that all property markets, I guess other than the inner city apartment market, rose at the same time. Capital cities, regional areas, outer suburbs, inner suburbs. I think we're going to have a more normal market this year where local factors are going to be more important, Andrew.
Yeah, and look, a normal market is really what we've been reaching for, Michael, basically since 2019, but we've had interruptions to that normalisation of the market. But if we have flat interest rates and flat wages growth, flat incomes, then our capacity to push up prices is constrained, and it will just reflect basically local conditions of supply and demand. But I believe, a normal market will see prices growth of around about 4 to 5% per annum, a little higher or a little lower, depending on what the local factors are of supply and demand, and that's levels of migration, home building, etc., and the nature of the local economy. But I do think that this is perhaps the nirvana going forward, Michael, of a much more settled and predictable housing market, where we don't have the roller coaster ride of interest rates to create the ups and downs and the booms and the busts, which have been particularly amplified given the interruptions over the past 2 or 3 years, notably from COVID.
While the Brisbane property market has been booming, and one used to say the sun was shining in the Sunshine State, unfortunately there are some terrible floods occurring in Brisbane at the moment, Andrew.
Well, it's deja vu to some degree, is it not, Michael? That certainly Brisbane is the outstanding housing market in the country at the moment, but unfortunately they're experiencing perhaps not a repeat at this stage of the floods of 2011, and we know that has certainly impacted housing market activity in the shorter term. But on a positive note, that Brisbane housing market did recover quite quickly post the floods then, but there's no doubt that in the shorter term, it will have an impact on just the capacity of buyers to be engaged in the market. So we need to keep our eye on that one, Michael.
Unfortunately, it's going to affect some people, so we're not belittling the effect on those whose houses and those whose businesses have been terribly disrupted, Andrew.
Yes, that's right, Michael. And as I said, there were significant issues in the 2011 flood that we remember, and we hope we don't get to that level currently, but certainly we're mindful of the impact that this can have, not just on the housing market, but as you suggested, on Brisbane generally.
You've already mentioned the auction markets, but just to finish off, February, it was a record month with lots of auctions in February, with creating some records in the number of sales.
Well, that's right. We had a record month for all markets, with the exception of Melbourne for February, which was just behind the records. The sellers had plenty of appetite to engage the market, and with clearance rates still pushing at or above 80% in most markets, it shows, well, why wouldn't you? It's just the difference will be the level of prices growth going forward. But certainly prices growth is still boom time levels in Adelaide and Brisbane. But the Melbourne and Sydney prices boom is well and truly over. But that doesn't mean that activity by buyers and sellers is over. It's as strong as it's ever been, particularly in our auction markets. And of course, big tests with the coming weekend. It's the first Super Saturday of the year. It's the pre-Labor Day in Melbourne, particularly the pre-Labor Day long weekend Super Saturday of auction. So again, that'll test markets' appetite, it'll test buyer depth, Michael, and it'll be interesting to see what the outcomes are. And likely we'll see some downward pressure on clearance rates with yet another wave of auctions to enter the marketplace. But nonetheless, clearance rates above 70% towards 80% clearly reflect a seller's market, but we're not going to see the prices growth that we've seen with those types of clearance rates before, because affordability has done its thing, Michael, and created, I guess, the natural stabiliser to our housing markets.
Well, hopefully that's going to keep APRA at bay and allow the markets to run their natural course. And currently there's going to be probably less talk about interest rates related to inflation and wages growth. So I guess the big elephant in the room is what's happening in those unfortunate circumstances overseas and how that's going to affect us with the Russian-Ukraine war.
Yes, Michael, and I'm sure we will get a raft of revisions in terms of predictions of higher interest rates sooner rather than later. And unfortunately, that uncertainty as a response to the European war is part of that equation. So let's hope that settles sooner rather than later as well.
That would be great news. Look forward to chatting again next week, Andrew. Thanks for your time.
Thanks, Michael.
Now, I want to clarify something that I just talked about with Dr. Andrew Wilson. We both agree that the Brisbane property market is going to be probably the strongest property market in 2022, despite the issues with the flood, which were terrible, but short term. However, there's not one Melbourne property market or one Sydney property market, and while overall, the property markets in Melbourne and Sydney won't grow as strongly. There will be some locations that will definitely outperform others. And it all has to do with, well, as Andrew said, affordability. But affordability means something very, very different to people with higher paying jobs with multiple streams of income. And that's why, while last year, outer suburbs, new house and land packages, all areas of Australia did well, moving forward, Melbourne and Sydney people can't afford the higher prices that have now crept up in the outer suburbs of Melbourne and Sydney. If you think about it, property values have gone up around 20%, but wages have only gone up 3% or so, if that. And for that reason, people are going to be priced out of those areas. But in the more affluent suburbs, the knowledge-based suburbs, people who've got skill level 1 and 2 occupations where their wages are going up, where they've got multiple streams of income, they're still going to be buying properties and they're still going to be pushing property values up. But again, not at the levels they were last year. So to secure your financial future through property, you can't just buy any property and you can't just get advice from anybody. You really need advice from a team that's got a holistic approach, that it's been around a number of times. See, last year everyone looked smart in the property market. Everyone was a property expert. But you, in my mind, need the support of a team that gives holistic approach. And that's what you get with Metropole. You're going to get some safety and security of using a team that has a very deep research base and makes independent recommendations, since we don't sell property. In fact, we customise a solution to meet your specific needs through our time-tested 360-degree system for acquiring wealth. So we help beginners buy their first property. We help experienced investors add to their portfolio, and sophisticated investors manufacture capital growth by becoming property developers or renovators. If you want to find out more, go to metropole.com.au, see our range of services. Why don't you just see how we can help you, if we can help you? Clearly our services don't suit everybody, but over the years our team have won multiple awards, been involved in over $4.5 billion worth of property transactions, and I'd love to be part of your wealth creation journey. So go to metropole.com.au, leave us your details, and let's have a chat.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to share the concept that successful people start before they feel ready. Now, let me tell you a story. In 1966, a dyslexic 16-year-old boy dropped out of school. With the help of a friend, he started a magazine for students and made money by selling ads to the local businesses. With only a little money to get started, he ran the operation out of the crypt inside his local church. 4 years later, he was looking for ways to grow his small magazine and started selling mail-order records to the students who bought his magazine. The records sold well enough that he built his first record store the next year. After 2 years of selling records, he decided to open his own record label, his own recording studio. He rented the recording studio out to local artists, including one named Mike Oldfield. In that small recording studio, Oldfield created his hit song Tubular Bells. Boy, does that bring back memories to me. I love that. And if you've been to any of my seminars, you know I play some Mike Oldfield music at the beginning of the seminars to create atmosphere. Anyway, Mike Oldfield became one of the record label's first releases. And that particular song, Tubular Bells, went on to sell over 5 million copies. Over the next decade, that young boy grew his record label by adding bands like the Sex Pistols, Culture Club and the Rolling Stones. Along the way, he continued starting companies, including an airline business, then trains, then mobile phones, and on and on. Now, almost 15 years later, there were over 400 companies under his direction, and today, that young boy who dropped out of school and kept starting things despite his inexperience, despite his lack of knowledge, today that young boy's a millionaire. And I guess by now you've recognised it, you've guessed it, his name's Richard Branson. Now, I recently read a story of how he started Virgin Airlines, And this tale seems to encapture his entire approach to business and life. Anyway, the version went something like this. He said he was in his late 20s and he had a bit of a business, but nobody knew who he was at the time. And he was headed to the Virgin Islands because he had a pretty girl waiting there for him. So he was determined to get there on time. But at the airport, the final flight to the Virgin Islands had been cancelled because of maintenance or something. It was the last flight out for that night. So Richard Branson thought, this is ridiculous, and he went and chartered a private aeroplane to take himself to the Virgin Islands. But he didn't have any money to do so, so he picked up a small blackboard and wrote something like, Virgin Airlines $29 on it, and went over to the group of people who'd just been on that flight that was cancelled, and he sold tickets for the rest of the seats on the plane and used their money to pay for the chartered plane, and they all went to the Virgin Islands that night. Now, amazing story, isn't it? Of course, Richard Branson's an extreme example, but we could all learn something from his approach. I guess one way of summarising the habits of successful people could be successful people start before they feel ready. If there was ever anyone who embodied this idea of starting before they felt ready, it really is obviously Richard Branson. The very name of his business group, Empire, Virgin, apparently he chose it because Branson and his partners started out as virgins when it came to business. Branson started so many businesses, so many ventures, charities, expeditions. It's simply not possible for him to have felt prepared, qualified already to start all of them. Couldn't have. In fact, it's unlikely that he was qualified or prepared to start any of them when you think about it. Apparently he's never flown a plane, didn't know anything about engineering of planes, but he started an airline company anyway. He's a perfect example of that saying, the chosen ones choose themselves. So my message to you today, at the beginning of a new decade, a time when you've probably got some good plans for yourself, is if you're working on something important, you'll never feel fully ready. A side effect of doing challenging work is that you're pulled by the excitement and pushed by the confusion at the same time. You're bound to feel uncertain, you're bound to feel unprepared and unqualified. But let me reassure you of this. What you have right now is enough. You can plan, you can delay, you can revise all you want, but trust me, what you have right now is enough to start. It doesn't matter if you're trying to start a business, trying to lose weight, write a book, achieve any number of goals, get going with property investment. Who you are, what you have, and what you know right now is good enough to get started at least. Now, we all start in the same place. No money, no resources, no contacts, no experience. The difference is some people, the winners, choose to start anyway. No matter where you are in the world and regardless of what you're working on, it's the start of a new year. Well, we're a little bit into it. It's the start of a new decade. I hope you're going to start before you feel ready. I hope you learned something from my chat with Andrew Wilson today, and if you did, and you know somebody else who'd get benefit from it, please tell them about the Michael Yardney podcast. I'm really proud of how our audience has grown because it's my aim to make as many people as possible financially independent, at least financially affluent, so they know what's going on. So please tell somebody about it, or tell the world by leaving a review wherever you listen to this podcast. And I'd also like to help you, as my way of saying thank you for taking the time out listening to me. Why not go to www.podcastbonus.com.au, where I've got a bonus of some ebooks and reports for you. Podcastbonus.com.au. I'll leave a link in the show notes so you can pick up your bundle of ebooks and reports. I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney or join my private Facebook group. Go to Facebook and look for the Property Update Facebook group, where every day I leave a little snippet of something to help you become a better investor. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?